Seeking shelter, investors flocked to bonds and quality stocks in 2023. As 2023 drew to a close, the global investment landscape presented a paradox. On one hand, a relentless series of headwinds from inflation and rate hikes to geopolitical instability and recessionary fears threatened to capsize markets. On the other hand, investors injected record sums into exchange-traded funds, ETFs, tracking two seemingly defensive assets, fixed income and quality stocks. This article delves into this intriguing trend, exploring the factors driving it and its potential implications for 2024 and beyond. A flight to safety. The year 2023 witnessed a dramatic shift in investor sentiment compared to the exuberance of 2021 and 2022, when growth-oriented stocks reigned supreme. As economic clouds gathered, the hunt for safety propelled investors towards bonds and quality stocks. These assets, characterized by strong financial fundamentals, stable cash flows, and dividend-paying potential, offered a haven amidst the volatility. Data from BlackRock paints a vivid picture. Despite falling short of 2021's peak, global ETFs garnered net inflows of $965 billion, the second highest annual figure ever recorded. Notably, fixed income ETFs raked in a record $332 billion, eclipsing the previous high of $282 billion set in 2021. This remarkable performance reflects a renewed appreciation for bonds in a rising rate environment, with investors seeking to lock in yields before further decline. Within the fixed income space, the narrative was nuanced. Sovereign bond ETFs, favored earlier in the year, saw inflows dwindle to $31.9 billion in the final quarter, the lowest since Q1 2022. Conversely, corporate bond ETFs witnessed a surge, attracting $29.1 billion in Q4. Notably, high-yield bonds, which faced outflows until October, enjoyed a remarkable turnaround, receiving $17.1 billion in the final months of the year. This suggests investors seeking higher returns were willing to venture into riskier territory while yields remained attractive. Quality stocks hold their ground here. While bonds took center stage, quality stocks also enjoyed robust inflows. Although falling short of the $1 trillion deluge witnessed in 2021, equity ETFs still brought in a hefty $640 billion. This demonstrates investor trust in established companies with resilient business models and the ability to maintain profitability even during economic downturns. Sectors like healthcare, consumer staples, and utilities particularly thrived, attracting investors seeking stability and dividend income. Within the quality stock basket, individual companies with strong governance, competitive advantages, and consistent track records emerged as clear winners. These firms not only weathered the market turbulence, but also delivered positive returns, further validating investors' defensive play. The underlying drivers. Several factors converged to fuel this flight to safety. 1. Inflation and rate hikes. As inflation soared and central banks embarked on aggressive tightening cycles, investors sought assets less vulnerable to rising rates. Bonds, especially inflation-linked issues, offered some protection against purchasing power erosion, while quality stocks' stable business models made them more resilient to higher borrowing costs. 2. Geopolitical uncertainty. The war in Ukraine and other geopolitical flashpoints heightened risk aversion, pushing investors towards assets perceived as safer havens. Bonds and quality stocks, with their predictable returns and lower volatility, provided a haven during periods of heightened anxiety. 3. Recessionary fears. Looming recessionary fears further emboldened the defensive move. With economic growth expectations dampened, investors prioritized capital preservation over chasing returns. Consequently, bonds and quality stocks, less susceptible to economic downturns, became the preferred choices. Looking ahead, will the trend of record inflows into bond and quality stock ETFs continue in 2024? The answer depends on the evolution of the aforementioned drivers. 1. Inflation trajectory. If inflation continues to decline as expected, investor appetite for bonds, particularly inflation-linked issues, might wane. Conversely, a resurgence of inflationary pressures could further reinforce the attraction of fixed income. 2. Central bank policy. The course of central bank actions will also play a crucial role. Continued rate hikes could make some bonds less attractive, while a pause or reversal in the tightening cycle could revive interest. 3. Geopolitical landscape. Any resolution or escalation of geopolitical tensions will directly impact risk appetite and influence the flow of funds towards defensive assets. 4. Economic performance. The ultimate direction of the economy will significantly impact investor sentiment. As recessionary fears materialize or dissipate, the appeal of quality stocks and bonds will adjust accordingly. Beyond the trends, exploring alternatives and activism. While the dominance of bonds and quality stocks in 2023 reflects a cautious investor mindset, other asset classes and investment strategies deserve attention. Here, we delve into 3 avenues that could gain traction alongside the mainstream trends. 1. Emerging markets and thematic ETFs. Developed markets may continue to grapple with headwinds, but emerging economies could offer compelling opportunities. Consider China's reopening. If China eases its zero-COVID policy, its economic rebound could benefit emerging market ETFs with significant China exposure. Southeast Asia's rise, with its young population, robust growth potential, and increasing economic integration, Southeast Asia could attract investor interest through regional or country-specific ETFs. Thematic ETFs. ETFs targeting specific themes like clean energy, healthcare innovation, or cybersecurity could offer exposure to nascent but high-growth sectors, providing diversification beyond traditional asset classes. 2. Active stock picking and tactical rotation. While quality stocks offer stability, a more active approach may also bear fruit. Value investing. Value stocks, often overlooked during growth periods, could become attractive if markets remain subdued. Actively seeking undervalued companies with strong fundamentals could yield significant returns once sentiment shifts. Sector rotation. While defensive sectors provide safe havens, rotating into cyclical sectors like construction or industrials based on economic indicators could generate alpha in case of a growth revival. Opportunistic shorting. In specific situations, shorting stocks in overvalued or vulnerable sectors could be a viable strategy, though it requires extensive due diligence and risk management. 3. Socially responsible investing, SRI. and ESG integration. Investors increasingly consider environmental, social, and governance (ESG) factors. This trend could shape portfolio construction in several ways. Sustainable investment strategies, integrating ESG criteria into investment decisions and actively seeking companies with strong ESG practices, could be a long-term growth driver, while aligning with ethical considerations. Impact investing, focusing on investments that directly address social and environmental challenges, such as renewable energy or affordable housing, could generate financial returns alongside positive societal impact. Engagement and proxy voting, actively engaging with companies on ESG issues and exercising shareholder rights through proxy voting can be a powerful tool for promoting positive change, even without outright divestment. Conclusion. Leo. Beyond the dominant trends of 2023, astute investors will explore emerging markets, thematic ETFs, active stock picking, and socially responsible strategies. Diversification within and across asset classes, continuous due diligence, and adapting to evolving market dynamics will be crucial for navigating the uncertain waters of 2024 and beyond. Remember, while safety in the form of bonds and quality stocks is paramount in volatile times, opportunities for alpha and meaningful impact lie beyond the mainstream trends, waiting to be discovered by investors who dare to venture past the safe harbors.